Hello guys, welcome to the accounting class. In today's video, we are going to discuss the MCQs relating to the current liabilities, provisions and contingencies. So let us begin the video. The first question is, which of the following is not an essential characteristics of a liability? Not an essential characteristics. So a liability has present obligation, yes. A liability arises from the past event, yes. A liability will result in an outflow of resources, yes. So it will result in an inflow of resources, no. A liability does not result in an inflow of resources. So the correct option will be the fourth option, because it is asking which is not an essential characteristic. So the fourth one is not an essential characteristics. The next question number 2, balances owed to others for goods, supplies or services purchased on credit are known as. So whenever the purchaser owe to others for goods, supplies or services because of purchasing on credit, this amount is known as unearned revenue, account payable, customer advances and deposits or sales tax payable. So unearned revenue, no, it is not. Account payable, yes, this is the correct answer. Customers advances and deposits, no. Sales tax payable, no. It becomes account payable because this is for the purchase of the goods, supplies or services. So the correct option is account payable. Next question, which of the following is not an example of current liabilities? Notes payable within 6 months, yes, it is current liability. It is not an example, so we cannot say that it is not an example. It is example. So this is not your option. Long term bonds payable, yeah, because of the long term it does not become the current liability. So option number C, option number 2, we get the correct one, but we have to see the other option as well. Sales tax payable, yes, it is current liability, so we cannot say that it is not current. Unearned revenue, it is also a current liability, so we cannot say it is not a current. So not current liability is the long term bonds payable, option number 2. Next question number 4, written promises to pay a certain sum of money on a specified future date is termed as, remember, written promise. So whenever there is a written promise, it is account payable. No, account payable is not a written promise, it is oral promise. Notes payable, yes, note payable is the written promise. Bonds payable, we don't consider it as a written promise because it is not a note or it is not a promissory note. Money payable, not, money payable is not any term, it has been included just to increase the option. No, so the correct option is note payable. Next question number 5, it has a numerical question. Gold National Bank lent $200,000 on March 1 to Silver Company. Silver Company signed a $200,000 6% 5-month note for the amount borrowed. If Silver Company prepares financial statements semi-annually means half yearly, which of the following amount is correct regarding adjustment entry on June 30? So it is semi-annually financial statement, therefore the half year will end on June 30. The question is about the amount to be recorded as adjusting entry on June 30. So first of all, we have to calculate the amount. The borrowed amount is 200,000. Okay, the rate of interest is 6%. Okay, now you have to make the adjustment entry on June 30. So you have to calculate the period. So from March 1 to June 30, it is how many months? From March 1 to June 30, March 1 to June 30, it become March, April, May, June, that is 4 months. Okay, so 4 months interest will be taken here for the adjustment entry. Now if we solve this, what amount we get? Let me check. After solving, we get 4,000. So 4,000 is the amount of interest payable on June 30. So it is the correct answer, 4,000. Okay, the other options are wrong. 4,000 is the correct option because we have to make an adjustment entry with this amount only on June 30. Next question, we have another numerical question. Beach company borrowed $80,000 from Ocean Bank by signing a 12-month zero interest bearing 96,000 note on October 1, 2022. The adjusting entry on December 31st, 2022 will be, you have to pass the adjusting entry with the correct amount. Okay, so in case of the zero interest bearing, the rate of interest is not given, but it does not mean that there is no interest. No, interest is there, but it is the difference between the amount borrowed and the amount to be paid. Okay, so total interest will be 96,000 minus 80,000. Total interest for the 12 months is 16,000. Okay, because this is a 12 months note, and an adjustment entry is passed on December 31. The note was issued on October 1. So take the period October 1 to December 31. How many months? October, November, December. That is 3 months. Okay. So now 16,000 is the total interest. It is to be converted into 3 months. It will become 4,000. Okay, so 4 1 is 4, 4 4 is 16. We get 4,000. This is the amount of adjusting entry. Now we have to see what is the correct entry. 4,000 we get in option number 3 and option number 4. So which one will be correct, 3 or 4? Will it be correct 4? Note payable debit to interest payable? No. The fourth one is wrong because we don't debit note payable for the interest amount. Interest expenses debit to note payable. Option number 3 is the correct one with the correct amount. Okay. Now move to the next question. Dividend payable in the form of additional shares. When the dividend is paid in the form of additional shares, it is called stock dividend. Okay, stock dividend. So what information is true about this stock dividend? Stock dividend are not recognized as liability. The first option is correct one. Second option, are recognized as liability? No. Do not represent retained earning? Wrong, because stock dividend represent retained earning. With the stock dividend, your retained earning will increase. So it represents retained earnings. So option number 3 is wrong because it is written not represent. Are not reported in equity? It is reported in equity because if retained earning is increased, it will increase the equity. Okay, so it is reported. Option 1 is the correct one. Now the next question. On conversion of account payable to notes payable, you have to pass an entry. So what will you do if you are converting the account payable to note payable? So if you are converting account payable, it means you are decreasing account payable and you are paying notes payable instead. It means you are increasing note payable. So Account payable is a liability, one liability is decreasing, note payable is also a liability, one liability is increasing. So in case of decrease in liability you have to debit, in case of increase in liability you have to credit. So see what option is correct. Account payable should be debited. Where is it? Account payable is debited. So we find option number 2 is the correct one. The first option, account payable is credited, it is wrong. No. Note payable is debited. No, note payable is not debited. Interest expense is credited. No, interest has nothing here for conversion. So the two option, account payable is debited, is the correct one. Next question, question number 9. Amount received before delivering goods or rendering services are called. Before giving goods to your customer or providing service to your customer, whatever amount you are receiving from them, it is called what? Earned revenue? No, it will be earned after providing the service and after delivering the goods. So it is not earned. Deferred revenue? No. Unearned revenue? Yes, it is the correct option. Revenue payable? No, there is no term like revenue payable. So the correct answer is unearned revenue. The next question, question number 10, it is numerical. Deluxe Corporation made credit sale of 477,000 including sales tax of 6%. Determine the amount of sales tax payable collected by the Deluxe Corporation. So there is a sale by a company, Deluxe Corporation, and with this sales, this company has collected 6% of the sales tax. So 477,000 is the collection along with the sales tax. So 477,000 is actually 106%. Why? Because it is the total, it is the amount of sale, amount of the goods sold plus sales tax. So 477,000 is equal to 106,000. What we have to find? We have to find the amount of sales tax. In this 106%, 6% is the sales tax. Okay. So with this, how can you find this 6%? We can do it like this: 477,000 upon 106. You have to find 6% separately, so multiply it by 6. Okay, you will solve it and you will get 27,000. So 27,000 is the amount of sales tax payable which is collected by Deluxe Corporation. So the other options are wrong. We find the correct option as 27,000. Next question, question number 11. A liability of uncertain timing or amount reported either as current or non-current liability. A liability of uncertain timing or amount, reported as current or non-current liability. It is what? It is provision, it is reserve, it is fund or operating expenses. No, it is not reserve, it is not fund, it is not operating expenses. It is what? It is provision. Next question. An obligation that is derived from company's action, like its past practices, its published policies, etc., is called. Sometimes it happens that a company was behaving like that. So because of its behavior, because of its practices, because of its policies, some obligations are derived. It is believed that the company will be having such obligation because of this practices. So such type of obligation is called with a specific term. What is that term? It is destructive obligation? No. It is called compulsory obligation? No. It is called default obligation? No. It is called constructive obligation. Next question, question number 13. An amount that a company would pay to settle the obligation at the statement of financial position date with reference to a provision, as per IFRS. So an amount with reference to a provision as per IFRS is which amount? that amount is actually an estimate. So what we call that estimate? Reliable estimate? No. We call best obligation? No. Reasonable estimate? No. We call them best estimate. So an amount which a company have to pay as provision regarding as per the IFRS, it is called best estimate. Question number 14. An amount of provision can be measured by management in the following way except. So there are 4, out of the 4, one is not the way of measuring the amount of provision. So you have to find that. Except means leaving that. So use of judgment, yes, a management of a company can use the judgment to decide the amount of provision. It is okay, no problem with this, it is used, it is not an exception. On the basis of past transaction or similar transaction, yes, it is also used by the managers. They can take the past transaction and similar transactions to decide the amount of provision. A discussion with expert, yes, it is also possible, they can do that, but choosing an amount randomly, no, this is an exception. Okay, so your correct option will be the 4th one. This is an exception. Question number 15. Companies do not record or report in the notes general risk contingencies inherent in business operation. Which of the following is not a general risk contingency? Which of the following is not? So possibility of war, yes, it is a general risk contingencies. A strike is also a general risk contingencies. Business recession is a general risk contingencies. So these are not your options because it is asking which is not. So warranties are not a general risk contingencies. Warranties are actually the provisions. So we can't say as a general risk contingency. So correct option is warranties. Now moving to the next question. Question 16. Which of the following is not true? Not true with reference to accrual basis or of method of accounting for warranty cost. For warranty cost, there are 2 methods. One of them is accrual basis method. So which is asking in this accrual basis method which is not applied, which is not true. Okay. So the first one is charge warranty cost to operating expenses in the year of sale. Yes, it is true. So it cannot be our option because we have to take not. Is the generally accepted method? Yes, this is a generally accepted method. The accrual basis is the generally accepted method for accounting for warranty cost. Is referred to as the expense warranty approach. Yes, so this is also not our correct option. Our correct option is the 4th one because charge warranty as cost incurred. This is not applied in accrual basis. Okay, so correct option is option number 4. Now 17. The unavoidable cost of meeting the obligations exceed the economic benefits expected to be received. Okay, in case of meeting the obligations, the cost of meeting the obligations sometimes exceed, sometimes is more than the benefit that we receive. So what we call this cost? We call this cost as, and we refer to this cost as provision for restructuring, onerous contract provision, warranties provision, premiums and coupon. What we call them? We call them onerous contract provision. So the correct option is option number 2, onerous contract provision. When there are some obligation which we cannot avoid, we have to do, but we know that the cost of doing and cost of fulfilling these obligations is more than the benefit that we are supposed to get, but we have to do because we are bound due to the contract. Okay, we cannot break the contract. So due to the contract we have to do that. Such cost is called onerous contract provision. The next question is, if a contingent liability is possible but not probable, what is the accounting treatment? There are some treatment about the contingent liability, you may have to read that. So we should report it as liability, we should not disclose, there is no disclosure required, or disclosure is required, or we report it in the income statement as loss. Disclosure is required, we have to disclose them. Okay, the correct option is C, the third one, disclosure is required. 19th question, the numerical question. From the following information, determine the acid test ratio. Cash 20,000, short term investment 1,500, net receivables 3,500, unearned revenue 6,000, prepaid expenses 4,000, account payable 4,000. So for determining the acid test ratio, we must know the formula, acid test ratio. It is equal to liquid assets upon current liabilities. Okay, liabilities. Now what are the liquid assets? Liquid assets are the cash, so we'll take 20,000 plus short term investment plus net receivable, that is 3,500. Okay, then we have to take current liabilities. In the liquid asset we don't count the prepaid expense. Okay, this prepaid expenses is not counted in the liquid asset. Then we have to take current liability. In the current liability we have to take this unearned revenue and account payable of 4,000. So 6,000 plus 4,000. Now we get 25,000 by 10,000. Okay, dividing it we get 2.5 is to 1. 2.5 is to 1. So our correct option becomes 2.5 is to 1. This is the acid test ratio, and the correct answer is 2. Now the next question, and this question is to be answered by you. You should answer this question in the comment box. In the comment box you can write your option, your choice as 1, 2, 3 or 4. Which of the following is not an example of the contingent asset? There are 4 options: possible refunds from the government in tax disputes, pending court cases with a probable favorable outcome, current maturities of a long term investment, possible receipts of donations. So you have to answer them in the comment box of this video. Thank you so much. I hope that you have enjoyed this video and these questions will help you a lot. Take care. Bye bye. See you in the next video.